In May 2010, the global financial system came within minutes of a market collapse that could have reshaped the modern economy. No recession had begun, no company had failed, and no external shock had occurred. A chain of automated actions nearly pushed the stock market into free fall. At the time, financial markets were increasingly dependent on electronic trading. High-frequency trading systems executed orders in milliseconds, responding to price movements faster than human traders could react. These systems were designed to provide liquidity and efficiency, but they also operated with limited human oversight during rapid market changes. On May 6, 2010, U.S. stock markets were already under pressure due to concerns about European sovereign debt. Volatility was elevated but still within normal limits. Trading volumes were high, and automated systems were actively buying and selling across markets. The critical moment began when a large institutional investor placed an automated sell order for stock index futures valued at billions of dollars. The algorithm was programmed to sell based on trading volume rather than price. As selling pressure increased, prices began to drop rapidly. High-frequency trading systems reacted instantly. Many began selling as prices fell, while others withdrew from the market entirely to avoid risk. Liquidity disappeared within seconds. Prices of major stocks collapsed dramatically, some briefly trading for a few cents. Others spiked unrealistically high. This was the point where everything almost changed. The Dow Jones Industrial Average fell nearly 1,000 points in minutes, the largest intraday drop ever recorded at that time. The speed and scale of the decline created confusion across global markets. If the decline had continued unchecked, confidence in electronic markets could have collapsed entirely. What stopped the crash was a combination of automated safeguards and human intervention. Exchange-level circuit breakers halted trading in affected securities. These pauses allowed prices to stabilize and gave market participants time to reassess conditions. Liquidity gradually returned, and prices recovered within minutes. By the end of the trading day, most losses had been reversed. The market closed significantly lower, but the systemic collapse never materialized. Subsequent investigations confirmed that no fundamental economic event caused the crash. It was the interaction between automated trading systems, market fragmentation, and sudden liquidity withdrawal. The systems behaved as designed, but their combined behavior produced an unintended outcome. If the crash had continued, the consequences would have been severe. Investor confidence could have collapsed globally. Retirement funds, pension systems, and institutional portfolios would have suffered extreme losses. Markets might have closed for extended periods, disrupting global finance and commerce. In response, regulators introduced new safeguards. Enhanced circuit breakers, order cancellation rules, and limits on high-frequency trading behavior were implemented to prevent similar events. Markets were redesigned to slow down when volatility reaches dangerous levels. The stock market crash that almost happened in 2010 was avoided not by economic recovery, but by structural safety mechanisms activating just in time. It demonstrated how close modern systems can come to failure without any external cause. History did not change that day because the system paused before it broke.